heading into this reporting season. I think the one stock that's got an awful lot of attention, particularly in the last month or so, is Telstra, and it's one that's looking very interesting. So I'll talk about that in a minute. But up here is our view of share price risk. So not necessarily will they beat or miss earnings expectations, but how we think share prices could actually react on the day. And in terms of the ones that are probably most relevant, we're moving our stance a little bit on Telstra, thinking it might actually react positively, and I'll explain why shortly. Other sort of positive candidates are NextDC and Megaport, and also worth noting Over the Wire and Superloop. Just two that we're a little bit cautious of, where we think there is a bit of downside risk. Clearly TPG, we've flagged that for a long time, out in September, their result. We think there's some risk there. And also Speedcast, just given the cash flow in that business, which I'll also talk about. So Telstra, they're reporting next Thursday, the 17th of August. We are moving our stance a little bit there from a downside to an upside risk candidate. We do still think there is risk around earnings and expectations next year being too high. But putting that aside, we think there's a reasonable chance the share price will react positively, just simply on the view that we finally, hopefully, got some certainty. So as a reminder, Telstra in November last year said within 12 months they'd put the result of their capital management review out. So it could very likely be August with their result that they give us that view. Worst case, it's November of this year, but it seems very logical that it would be August. And clearly everyone's worrying about the dividend here, whether Telstra is going to cut or hold the dividend. We have to wait for that result to know. But I think it's worth just having a look at the share price and what the share price is implying. So if you look at Telstra, historically the yield on it's been about 6.1% over around 20 years. So right now the market's telling you they don't believe that Telstra is going to pay a 31-cent dividend. If you back solve today's share price to get that 6.1% yield, you're looking at a 25-cent dividend implied by the share price. And if you look at our research, we've said for a while we think that's the worst case scenario. So I think the market is pricing in a worst case scenario here on the dividend, and we've seen with a few other very large cap companies, when you've got some certainty, companies like BHP and ANZ, when you've got some certainty over the dividend, they've actually tended to react relatively positively. So changing our stance there a little bit. Obviously we need to see what the view is with capital management, but certainly one we're thinking you should consider as an active opportunity into the result. So we'll have investor relations in shortly after the result, and also from the Brisbane office we'll have the CFO presenting not long after, so certainly we should get some good news flow from them after the result as well. The second positive candidate, NextDC, reporting on the last day of August. They've pushed that back. We know they're going to hit their guidance with the exception of CapEx. They've managed to spend $100 million less than they expected. So, what's that all about? I think there's two concerns on the share price, why it's come back a little bit. The first is obviously AJD, the property REIT, and what's going on there. NextDC have lodged that unconditional bid, and we've got the 360 stuff happening at the same time as well. They said once they'd got access to all the information for their due diligence, they'd come back to the market within 3 weeks. So it's quite possible we hear what they're planning to do before NextDC's result. If we know what they're going to do, then we know what NextDC needs to do next, I guess. So the point being, it's quite possible this AJD stuff gets resolved before NextDC report in August, which would be a tick. And the second issue is these new facilities. As I said, they've spent $100 million less than their guidance. So people are wondering, why haven't they spent as much? Is everything tracking, slower than they thought? The picture you can see here is a photo we had taken on Friday of their Melbourne data centre, which is meant to be practically complete about now. As you can see from the photo, it doesn't look practically complete. But the point is, whether this is, whether it went live practically complete on the 30th of June or it's a couple of months late, doesn't actually bother me in the least. I'll show you a photo of the Brisbane facility, which this is Brisbane 2, looks pretty much practically complete to me. So, we're borderline here. Whether these things are technically practically complete, but the reality is a couple of months here or there doesn't actually matter. And more importantly, if you look at our earnings expectations, which line up with consensus next year, we've got about $6 million of costs actually coming through on the new facilities. So minus $6 million because these things take a while to fill up, obviously. So they cost money initially. So if these haven't actually been turned on, it's quite possible it's an upgrade, not a downgrade to expectations, just because you don't have as many costs coming through when you think. But either way, we think, when the market knows what's going on with these things, the Generation 2 facilities, you'll get some certainty. And if they can solve those two questions about AJD and the next generation facilities, we could see positive movement on the share price there for NextDC. And then if I just quickly talk on a couple of other ones that I think are upside risks. Megaport, we've seen their numbers. They released a quarterly. So we do know that we're not going to walk into anything surprising. And they've got a strong cash balance now, having recently raised capital. So we think that's a good story. And it's all about the take-up in Australia and North America. You saw some big numbers in terms of customers added in the last couple of months. So if they can show us they're getting some good traction there, I think the market will like that. Over the Wire is another one, should deliver some strong cash flow in the second half of 17. They had a pretty weak operating cash flow in the first half. So I think that and some decent results should put them on track for next year with some pretty good growth, growing well above the telco sector average, but trading basically in line with the telco sector. So a good play there. And then finally one, we've been on the fence for a while with is Superloop. We think it's a great business. It's just a matter of how long does it take for them to get traction in these new markets. We know they've been in Singapore for about 24 months now. So we're hoping about now we should see a bit of traction out of the Singapore business. When we last heard from them, they had around $3 million of recurring revenue out of Singapore. So clearly they need to move the dial on revenue. If they can get that ramping up, I think the market will react positively to that. That's certainly what I'm looking for. But we know the headline numbers are going to look good anyway. They'll have 6 months of Big Air, which they acquired late last year. So all the numbers are going to, on a headline level, look very positive. So I think that's one to keep an eye on as well. And just finishing off, I guess, on the downside candidates, or neutral Vocus, it's all about the private equity bids or not bids and how that transpires. So no need to jump in front of that one. Speedcast, they did flag about 6 months ago that they would have a weak first half and a strong second half. So that shouldn't be a surprise to anyone, but we do know that markets tend to jump around a bit on things like this. If you look at the operating cash flow and the free cash flow, I think that's the thing I've been very focused on, and I think the market will be too. I don't expect to see a lot of free cash flow, maybe a couple of $1 million of free cash flow in the current half. Obviously, they've bitten off a very big acquisition, but I guess the point is this is a second half story, so don't expect the market to react overly positively to this first half result. And TPG, we think earnings expectations are just too high. The point of that chart is that today, 1 in 2 households in Australia can choose to use the national broadband network. It's only 1 in 3 that are actually using it because of the negative publicity, obviously. But the point is, we've reached this halfway mark now, and margins get heavily crimped under the NBN. So moving into next year, you've got some very big headwinds, should I say, in terms of underlying trends for this business, and their guidance is for EBITDA to decline in the second half, yet the market still has EBITDA growing next year, which we think is way too optimistic.